Welcome to Morphic Labs, and today we are at the end of our market microstructure and trading systems course. If you've watched all the videos, or at least most of them up until this far, congratulations, you have increased your market IQ, and you should give yourself a round of applause. But today we are going to be discussing market impact, and we are going to be comparing all the aggregations that I showed and how they relate to each other. And we are also going to be talking about Shannon information bars for my advanced market aggregation course. But before we get into that, do me a favor, hit the subscribe button if you want to keep up with more content like this. And if you're interested in increasing your market intelligence, I have a free market microstructure and trading systems course, plus an advanced market aggregation course. The links in the description. You just gotta sign up to be a free member, and you'll have full access to both of them. Now, let's get into it. 3.1.9 comparison of aggregation methods. Only going to be comparing up until run bars, and we're going to be minusing the advanced aggregation technique because can't really put it side by side with these very basic simple aggregations. Now the table has 4 columns: method, trigger, best for, and key metric. Now let's get started. Time bars have a trigger that's fixed time interval, or they're triggered by a fixed time interval. They're best for standard technical analysis and reporting. Their key metric is time, or delta T. Tick bars are triggered by a fixed trade count, best for microstructure research, and their key metric is T, or the trade count. Volume bars are triggered by a fixed volume, best for liquidity analysis, and their key metric is volume. Dollar bars are triggered by a fixed dollar value, best for multi-asset strategies, and their key metric is value, i.e. price times volume. Range bars, they are triggered by a price range, best for volatility analysis, and their key metric is range, or H minus L, or high minus low. Renko are triggered by a fixed price increment, and they're best for trend following. Their key metric is brick size. Kagi are triggered by reversal thresholds, and they're best for supply and demand analysis, and their key metric is reversal percentage R. Imbalance bars, they're triggered by order flow imbalance. They're best for informed trading detection, and their key metric is imbalance, or theta. Run bars, they're triggered by consecutive direction, best for momentum strategies, and their key metric is run count. 3.1.10 Practical implementation considerations. When implementing aggregation methods in production systems, several practical considerations arise. Data quality. Aggregation is only as good as the underlying tick data. Timestamp accuracy, trade classification, buy/seller initiated, and the handling of corrections and cancellations all affect aggregation quality. Parameter selection. Most aggregation methods require selecting a threshold or a target value. This should be based on the specific instrument's characteristics and the analytical objectives. Common approaches include percentile-based, set threshold and 90th percentile of historical distribution; event-based, target specific numbers of bars per trading session; volatility-adjusted scale threshold based on recent volatility. Me personally, if I'm ever building a simple, strategy, I'd rather choose, or I usually choose, a percentile based, and set the threshold to the 9th percentile of the historical distribution. But depending on what you need, event based is also very useful. Volatility, I usually don't do it, but depending on your strategy, agenda, risk, whatever, you should look into it, because you can be picking key metrics, or at least values for these metrics out of your ass. Excuse my language. You can't just be picking them randomly, right? You need some sort of strategic parameter selection. Computational efficiency. For high frequency applications, consider streaming algorithms that process ticks in real time. Approximation methods for complex aggregation, pre-aggregation and multiple thresholds, cross-instrument consistency. When analyzing multiple instruments, consider normalizing aggregation parameters by average daily volume. Price level, volatility. Summary. The choice of aggregation method fundamentally shapes the statistical properties of market data and the effectiveness of downstream analysis. Time-based aggregation remains the industry standard, for its simplicity and compatibility with existing tools. Time-based aggregation, honestly, I'm gonna just say it. I think the market has squeezed every single last drop of edge out of time-based aggregation, right? Because everybody in their grandmas at every quant firm, every institution is looking at time-based aggregation, right? And essentially, if we're most of us are looking at a time-based aggregator, that means most of us are essentially blind to non-time-based aggregators, right? So I would say in the current market environment, or the market geometry as a whole, how the geometry of the market is put together, or let me call it the opportunity geometry of the market. The best way to get opportunities nowadays, okay, let me say this before I get into that. In the market space that we have now, the opportunity geometry, there's only three ways to get rich, or at least have an edge. You don't have to be rich from it, but there's only three ways to really make money. Only three. Either you're faster, you're more informed, or you're smarter. There's no in betweens, right? And being faster is very expensive. Most of us can afford that. Being informed, either you want to be an inside trader, or you know something that someone else doesn't know. But in today's world, that's very rare. The data that so some quant on Wall Street has is probably the same data that some solo trader in Russia has, right? The information is not really an advantage anymore unless it's insider information. And the third way to actually win in this current opportunity geometry is being smarter, right? Because if everybody's looking at time-based aggregation or volatility or whatever, and you start looking at the data differently, you start seeing things that they wouldn't even think is possible to see, right? You start seeing patterns, inconsistencies, and invariants that you can exploit and take advantage of. But I'm getting a little bit too ahead of myself. Let's get back to it. Time-based aggregation remains the industry standard for its simplicity and compatibility with existing tools, but alternative methods offer significant advantages for specific applications. Use tick bars for microstructure research and when trade frequency varies significantly. Use volume bars for liquidity-sensitive analysis and volume confirmation strategies. Use dollar bars for multi-asset portfolios and cross-sectional studies. Use range Renko Keggy bars for volatility-based strategies and noise reduction. Use imbalance run bars for high-frequency strategies and informed trading detection. Understanding the trade-offs between these methods is essential for practitioners seeking to extract meaningful signals from market data. 3.2 Liquidity and market impact. Liquidity is the ease with which an asset can be bought or sold without affecting its price. It has multiple dimensions: breadth, tightness of the bid-ask spread, depth, quantity available at each price level, and resiliency, speed of price recovery after a large trade. Market impact is the change in price caused by executing an order. It has two components: temporary impact, the immediate price movement that dissipates over time, and permanent impact, the lasting change in price that reflects the information content of the trade. Understanding and modeling market impact is essential for optimal execution. And over here, we have a market impact model. Now, that's about it for Market Intelligence Masterclass Series Module 1, Market Microstructure. And in honestly, this has been a good run. I enjoyed going through this course, but it has come to an end, at least content wise. Anyone wants it, link still in the description. But let's get into the code and look at market impact. Now, as you can see, it's the same code from the book. I'm just going to run it. Actually, I've already run it, so yeah. Now, we have a sigma or daily volatility of 0.02, and we have a volume of 1,000,000, and we have a quantity, order quantity of 50,000, right? And now we're going to essentially calculate this. And as you can see, after calculating, we have a temporary market impact of 0.00223 and a permanent impact of 0.0005. and the temporary impact is actually 0.22%, and the permanent impact is 0.05% impact, right? The lower, the better. But me and you are small fish in an infinite ocean compared to the people who actually impact markets. So unless you're either trading penny stocks or you're a billionaire, you really shouldn't worry about market impact. Me and you are far, far too small to even exist, right? Our market impact is probably 0.0000000000001%. But yeah, let's get into Shannon information bars. Now, what is a Shannon information bar? Shannon information bars measure the surprise or information content of individual price movements, aggregating until a cumulative information threshold is reached. Here's the formal description. Each price movement carries information proportional to its unexpectedness relative to the observed distribution. Formulas. Information content of return. The information of R sub I equals negative log sub 2 of P of R sub I, where P of R sub I is the probability of observing return R sub I. Cumulative information I sub total equals the sum of I of R sub I, where I indexes from 1 up until n, equals the negative sum of log sub 2 of P of R sub I, where I indexes from 1 up until n. Bar close condition. I sub total is greater than or equal than sum I sub target. Where do you use this type of aggregation? Event detection and monitoring. Abnormal return identification. Information flow analysis. Market surprise quantification. Algorithmic news trading. Advantages. Direct measure of information arrival. Large moves carry more information. Natural event detection capability. Grounded in communication theory, useful for regime change detection. The disadvantages: requires probability model misspecification risk, computationally demanding, historical probability estimation, complex implementation. Now let's get into the code. I'm going to be using my 1 minute Tesla data. And I've already ran this. And as you can see, our target is about 10 bits, right? And every single close here that you see, or every single bar, represents the target being met. But this is information that, just looking at it like this, you might as well be blind. Let me just change up something real quick. Okay. Take just the first 100 entries. And as you can see, here's our Shannon information bars, right? And essentially, when you look at the cumulative information at a bar close, which is in equation 6 to 5, essentially, the total information, this period where it increases, decreases, increases, decreases, increases, decreases, increases, decreases, right? And our target threshold is essentially at 10, right? So whenever it gets crossed, these bars get met and the condition is met. But now I'm gonna be running this for a fairly large entry, about 1,000. I'm not going to show the cumulative information at first. Okay, I just wanted to see the geometry. And as you can see, our target hit, 10 bits gets hit, well, almost all the time, right? Almost all the time. And as you can see, when we go from 0 to about 1,000, the information, the total information it's strictly moving above, right, 10 bits most of the time, if not all the time, right? Because I do not see a single bar that is below. Okay, here's one. Is it even a bar or is it just zero? But either way, the bars that are below 10 bits very minuscule, right? But that's about it for today. If you're interested in increasing your market intelligence, I have a free market microstructure and trading systems course plus an advanced market aggregation course. The links in the description, they're both free. You just gotta sign up to be a free member and you'll have it all to yourself. And that's about it for today. I'm out here. Bye.